Joining us at Post 9 today, Regions Asset Management CIO Alan McKnight is back. It's great to have you back, Alan.
Thanks, Carl. Thanks for having me.
How impressed have you been by this admittedly early phase of the reporting season?
It's still really early, but if you look at the data so far, what we're not hearing is anything coming over the cliff. We're not hearing CEOs say, look, we think that things are really going to be tough at the end of the year and into next year. So generally pretty positive. We still want to see some more data, particularly out of the consumer. That will tell us quite a bit. But right now, we think things look pretty good.
You think this is the trickle down from the new rate environment? Is it already hitting?
We don't think it's hit quite yet, but we think that the U.S. consumer is so resilient. If you've ever seen the movie Dirty Dancing from the 1980s, and there's a comment, nobody puts baby in the corner, nobody puts the U.S. consumer in the corner. And right now, the U.S. consumer really wants to continue spending. With rates coming down, they can continue to do so. It's not a panacea, but they are able to actually deliver from a spending perspective. We saw that in the retail sales.
Nice reference. Brings back a lot of memories.
I've had the time
Good
of
and
my
bad,
life.
yeah.
But to your point, if earnings expectations were low coming in and they're going higher, how much longer can we continue to revise higher? Because the consumer does continue to surprise us positively.
I think that's the great challenge for 2025, because what we've seen thus far is that we've been able to layer in some operating margin improvement, including some sales growth. Next year, we're going to have to see them sustain that, and I think that's going to be difficult. So we see growth coming down next year, and then you start to question, okay, where will valuations end up? If we're trading at 22, 23 times earnings right now, we're going to need at least base case of current earnings to be able to maintain that. If not, it could be a little choppy.
But just to play devil's advocate, why is it hard to maintain if the Fed is cutting rates?
Well, we think that the cost base is coming down, but it never comes down quite as quickly as you might like, similar to inflation. So wages are coming down. The wage cost is coming down. You see commodity prices coming down. You see other aspects of the inputs coming down, but they don't come down in a linear trajectory. So I think that's where companies are fighting to try to continue to pass along some of those increases.
Are you hearing from clients who maybe haven't been participating in equities a lot this year, suddenly wanting to? I mean, is that migration happening? New marginal buyers of stocks, that whole thing?
It is, and I think folks have been so concerned over the course of this year. You go back to this time last year when everyone was gnashing their teeth, saying it's going to be so difficult. So now people are getting to the point of, we're getting close to the end of the year, maybe we should go and just put some to work. And our view is stay balanced on that. You don't need to go chase the high flyers. Don't go chase just the names that have been working. Have a broad, equal-weighted sort of view around quality, if you will.
But you are bullish on utilities, right, which have been on a tear.
We are. And in that case, we think it's really a new world in terms of utilities. When you look at some of the news coming out right now regarding the growth across the power sector, if you had told me 5 years ago that we would be talking about nuclear power at this point and the level that we were getting interested in that for data centers, I would have been scratching my head. And yet here we are. And so I think that's what we're looking at over the next 3 to 5 years for utilities.
Why do you avoid industrials in this environment where things are looking up? And manufacturing has been one of the weaker spots.
We think it's going to continue to be relatively weak. So it's not that we think that it's going to have a real challenging environment as much as we think they're better places to put capital right now. And we think industrials are going to have a slog through 2025. Eventually into 26, CapEx start to pick up again. Maybe you could see a benefit there, but just not right now.